Hey, this is Trader Travis, and I'm here with a market and trade recap video. Now, I have a lot to cover in this video, so it may be a little longer than usual. But first, what I want to do is point out today's huge down day in the market. Now, I'm watching CNBC, and everybody's arguing back and forth as to why the market is down. Everybody's, saying their reason. They thought that the economy is great, and that, hey, this is just a correction. Other people say, no, the economy is bad, and that the Fed's giving you an illusion. Is they're only holding up the market because of their bond buying. But the reality is the market, the economy is bad. I'm like, which one is it? Good or bad? The thing is, everybody's arguing and they're looking for reasons why the market is down. They're looking for reasons. I'm looking for results. Reasons don't matter. Only results do. All right. They're looking for reasons. I'm looking for ways to profit. That's what I want you to do. Forget about the reasons. And here's something else I want you to think about. Recently, looking at my trades here, I've been, I bought USO, the stock here not too long ago. I sold some cover calls, cash secured puts on it in the last few days and last few days or weeks and earned some money off of it, for this long-term account up to 3,000 so far. Now, let me ask you something. Did CNBC survey me to see why I was making these trades? Did they survey me to see why I was buying the stock? Have they ever surveyed you to see why you're selling the stock? The answer is no. So when they're giving these reasons as to why the market is down, can you honestly believe that? Did they survey the hundreds of thousands of investors out there trading the market and ask, why are you selling today? So if they don't know, then you only can reason that it's all speculation. All right. And you also have to remember that they're a news channel. Their job is to sell ad space. So their job is to be, highly convicted and convincing about their thoughts, and they actually might believe their reasoning. And honestly, I don't, it doesn't matter to me. It's that I have to be detached and just pay attention to what I see, trade what I see, not what I think I'm going to see. Now, I want to give you a personal analogy. I'll share the personal analogy now, and then I'll talk about it a little later because I actually have a couple of questions, the FAQ questions I want to cover here, and that's going to tie into that. So think about something, my past. I was a bad boy. I've done a lot of things I'm not proud of. When I go back home, it's kind of tough for me because I have to relive my past all the time. And, the funny thing is most of the people who've known me most of my life, the first question they always ask me is when they see me is, hey, you staying out of trouble? And, that shows you what type of person I used to be. It's like everybody just assumes I'm getting in trouble or I'm always in trouble. And despite, the change I've made in my life, missions trips and the money we give to charity and, how much good we put into the world right now, they don't see that. They're stuck in their head and they're thinking about who I used to be. So what they see and what they think are conflicting. They have a hard time seeing that Travis is not the same guy. They have a hard time seeing that reality is because they're stuck in their head. This is why I don't watch the news. And this is why I always encourage students not to watch the news. Because when you're watching the news and you're hearing CNBC and they're talking about the bond buying from Ben Bernanke and the Fed and all this and that, you're stuck in your head. And it's a challenge seeing what's reality is happening. All right. So keep that in mind. So that's why I want to be objective in the market. Just like if a person was objective on me, they would say, forget his past. Let's not judge him on his past. The past is the past. We only focus on the present. And let's look at what he's actually doing. They would have a different interpretation and impression of who I am. But it's the people who, have that stuff in their head, that head trash is what I call it. They're the ones who have a hard time seeing reality. All right. So keep that in mind. That's the analogy I want you to think about when it comes to the news and listening to all that. It makes it harder for you to be objective and to really see what's going on. So before I run on there on that rant, let me, one last thing here. One last rant. The thing that concerns me that should encourage you is that the market has been bleeding money for the last month. All right. The correlation of the market goes down, bonds goes up. Well, let's look at that correlation. The 30-year bond fund TLT is down too. That's not supposed to happen. Bonds are supposed to be going up. All right. Bonds are going down. The market's going down. Let's go to another safe haven. Gold. Gold's been crashing for the last 9 months. Everything's falling in price. There's like absolutely nowhere for people to run who want that safe option to invest their money. So I'm like, after a while, they've got to pull their money out. I'm not sure. I'm speculating here, but it does concern me because I'm like, wow, there's nowhere for people to run. So that fear factor is going to pick up here soon. But, it should be encouraging to use because guess what? You don't have to worry about that. Can you imagine how fearful it is for the average investor right now with nowhere to run? They don't have the skill set and the tools that you have. You can profit no matter what. I just sold a credit spread today. I sold some cover calls the other day. I'm still bringing in cash. And as soon as the market turns over some more, I'm going to start buying put options here. Because then it's safer to trade directionally. And so, we have a tool. I feel bad for everyone else, but that's why I teach. I give them an opportunity to learn, but you should be encouraged because you don't have to bask in that fear anymore. So stop getting scared at what they say on the news because you're a different investor now. All right. So, I messed up this PowerPoint slide. So let's, just look at these two questions real quick. Let's look at them in conjunction. I didn't have it. So the bullet points came one at a time. So, I made a mistake here today. I was, made some trades here. I sold a credit spread on SPY. All right. And I've been in cash for about a month and I haven't traded. I've looked at the market just about every day, but I haven't traded. So I'm rusty, right? And so here I am. I was looking at SPY. I looked at it. I'm bearish on SPY now. And after today's market, I was like, well, the moving averages are all starting to point down. The long term, the short term has been pointing down, but the long term is starting to point down. And I'm like, okay, well, let's put on the big 3 template actually. And I'm like, well, the 30 day started to point down today. And I'm like, okay, so once the 30 day starts pointing down, it could be another correction like it was back here. So that'll be an opportunity for me to sell some put options on it. Not sell some put options. You're getting bearish trades. There I go again, screwing up. Mainly, I'm bearish on the stock. So my mind was stuck on put options. So I sent out a trade alert today, and I wound up doing a put credit spread. And if you studied the credit spread training, then you know that a put credit spread, you make money when the stock goes up. And so that shows you that how even after you've been doing it so long, you still can make mistakes. And this is one of the reasons why I don't come out strong after a trading break. I don't open like 10 trades at a time. It's just that, I crawl into my trades. I'll open like one at a time to get back in the swing of things. And this is the second mistake I made, this week. Earlier this week, I sent you an email where I made the mistake on the cash secured put I sold. But I won't cover that. I'll touch on that in the email. So anyway, I had to change my stance and go on the other side and then do a bear call, a credit spread. All right. So I apologize for that mistake. And that goes to show that, that's what happens when you're rusty. And this is just for me taking a trading break. Now, in a 50K information video, I'll talk about the reason it took me so long to succeed is that I had a lot of false starts. I would take a lot of breaks from learning. I'd take 6 months, I'd get busy with life, come back to the training, and it's like I had forgotten everything. And that, that happens. You get rusty, you forget your skill set. It's like working out. If you don't work out for 3 weeks, then, your body's going to change and it's going to be a little bit tougher once you start working out. It's the same thing with trading. And so that's why, it helps to try to look at the market every day, even if it's like 5-10 minutes, to keep active in this. And so that way you don't lose that skill set and that muscle memory. But anyway, I thank everyone for the emails they sent, because, someone was saying, are you selling a call credit spread? Because your email talks about you're bearish in the market, but you made a bullish trade. I'm confused or I'm missing something. So great catch. That shows me that you all are thinking about this. I'll keep my eye on this person and everyone else who sent the email because they're most likely going to succeed. And I'll talk about if you blindly follow my trades and don't think, then you'll most likely fail because that's like being on welfare. You're just taking a handout. You're not really working for your wealth. But this person looked at my trade and started thinking about it. It was like, they didn't just blindly like, oh, Travis is getting this, let me jump in too. He actually thought about it. He's like, something's not right here. I don't get this. So he's thinking about it. He's not blindly following me. And that's the skill set that's developed when you just don't follow everyone's trade. And you actually use what I do to enhance your skill set. Second question was, this person wanted to know my thought process here. Same thing. He's paying attention to what I did. I said I was bearish, but I made a bullish trade. So I guess he was thinking that I was trying to make a contrarian play. So he says, are you expecting SPY to rebound and get above 161 to get both legs out of the money and expire worthless? Or are you going to exit when you achieve 70-80% of the profit? So let's look at that. So essentially what he was thinking, I guess he was thinking that I thought out the SPY would bounce up, that this would just be a short-term pullback and SPY would bounce up. So it's more like a contrarian play, selling, on a little short pullback here. Now, there's some traders who trade that way, but I don't. I don't like to anticipate. I kind of wait and see type of trader. So what I see is the market has been going down. I see the 30 starting to tip down here. So I'm anticipating a little bit more downward movement based on what I see in the moving averages and the stock falling. So that's why I wanted to make a bearish trade. Now, as far as the 70-80% profit, that's usually my exit point for credit spreads. You know, I don't try to get greedy. I just try to, hit a profit target of about 70-80%. Every now and then I will do a technical exit like this. Let's see, let's change this to a line chart here. The last area of, support is somewhere around here, give or take. It's somewhere around this price area. So if I was going to do a technical exit on any trade, whether it's just credit spread or anything else, I would say, okay, I expect SPY to fall to this point, and once it hits that point, I'm going to close out the credit spread because I expect to bounce off support and go back up. So that would be a way that I would do the whole bounce up. I would look for some technical area, a bounce off support. But in that case, I would have sold a bull put credit spread here. I would have waited for it to touch this line. And if I was doing a contrarian play and I thought it would bounce off, as soon as it hit this line or around this line, I would do a bull put credit spread and in anticipation of the SPY bouncing off of it. But again, I don't trade that way. It just doesn't work for me. I kind of just wait and see and then get in alignment with whatever the stock market is doing. I have a higher success rate doing that. But I do want to congratulate these people for thinking through this and asking me these questions and catching me. Because honestly, guys and gals, I didn't catch the mistake. Because when I first made the trade, I was making money. I'm like, cool, everything's working out. And then I got all these emails. I'm like, what are they talking about? And I looked, I'm like, oh my gosh. I actually placed the trade. It wasn't that I actually made the mistake in email. I actually placed the trade. That shows you how rusty I was. So I placed a trade and then I wound up having to buy it back for a small loss and then got back in the right trade and received $1,500 cash immediately in my account. All right. So, that's that. So thank you all for that. You actually saved me some money and helped me to really get on the ball, and realize that, geez, I'm more rusty than I thought. So, I'm really going to have to crawl my way back into trading here in the next few days. All right. Now, before I answer this next question, I want to talk about this, this is a success story to me, is that this person wanted to say they had one of the most successful 2 weeks of trading they've ever had. They've made no trades. They were dying to trade, but was disciplined and did not pull the trigger. Like you, I saw quite a few trades and they all would have lost. I was positive that the market was going to rocket up after the Fed meeting. Trade what you see, not what you think you might see. Thanks for all you have taught me and all that you do. And this email was actually from Tim, and Tim, I actually have to thank you. Thank you for honoring the things I do, and thank you for sitting tight in cash. What Tim is referring to is I sent out an email to 50K members, and I said, look, I saw a lot of trades over the last couple of weeks, a lot that I wanted to make. I mean, Apple, Google, it was just so many stocks. I'm like, I wanted to make them, but I was like, oh, the market's pulling back. I just wasn't quite confident. It's just something didn't feel right. And I was like, these charts also didn't look 100% strong. Disney, DIS, I think, was one of the strongest stocks lately. And even that was pulling back. It's just that everything was making me feel uncomfortable. And so I sat in cash. I've been in cash for almost a month. Now, being patient was hard. Just like Tim, I saw a lot of trades I wanted to make, and I almost made them. Every single one would have wound up losing the money. Every single one would have wound up being a losing trade. All right? I look back after the fact, I'm like, wow, I'm so glad I didn't make those trades because I would have lost money. And so that's what he was talking about. Now, being patient is hard, but it's worth it. You can see it here. Just Tim. He said he's had the most successful 2 weeks trading ever, and that's staying in cash. New traders have a hard time realizing that cash is a position. Do not think that cash means you're not taking advantage of anything, you're missing out. No, cash is a position. It's one of the most successful and sophisticated positions you can ever be in. That's why Warren Buffett is the world's richest investor, because he's willing and has the patience to stay in cash a lot longer than anybody else. But it's hard. I'm not going to lie. I had several temper tantrums the last few weeks. Whining and complaining, throwing my feet down, like, I want to trade, but I was like, I'm telling myself the same thing I tell you. Be patient. Patience equals profits. I'm like recanting my own axioms to myself. But now that I see the performance on my account, let's look at that. All right. Matter of fact, I have a performance comparison, like my account versus the S&P here. Okay, so for my long-term account, as of today, I haven't, this profit is not entirely mine yet. I gotta wait till the trade plays out. But as of today, it's 38%. If I get rid of this trade right here, count is up 35%. So 35, 38, it's still pretty good. Okay, short-term account, up 37%. Same thing, if I take away the cash I received today on the SPY credit spread, I think it's going to be 33%. Yep, 33%. Okay. And then I have the DMA template, which is what I teach in the basic course, the template that you all learn. That account is up 14%. And that account started later in the year. And it's because, I didn't start that class until later in the year. So let's look here. I have this pulled up. Let's look at this difference here. The DMA portfolio, and I have it from the start date of when I made my first trade here on 3/14. Okay. So with the DMA portfolio, the stock market closed on 3/14. Now the stock market is what I'm looking at is the S&P here. Okay, I'm tracking, because your job here as a trader, I don't know if I've told you this, I'm sure it's in one of my videos, is your job is not to turn 5,000 into $1 million in a year. It's not to double your account in a year. It's just to beat the S&P 500, to beat the professional mutual fund investors, because 90% of them never beat it in a year. Okay, your job is to beat the S&P. That's what you want to do. That's what you track. So the S&P closed on March 14th of this year at 1563. As of today, the price close is 1588.19. And so what I did was take my calculator and I just subtracted, closing price from opening price. So from March 14th to now, the S&P has only went up $24 or a 1.6% increase. Okay. So in the last 3 months of all that price movement, it's only increased 1.6%. So long-term investors, mutual fund investors, people who are invested just in the S&P, they had to wait 3 months for 1.6% gain. Now that's kind of depressing. All right. Now you compare that with the DMA trades here. Okay. Up 14%. Part of the reason I'm up 14% is because I've been in cash. I wanted to trade, but I didn't. So if I did trade, I would have lost money and I wouldn't be up 14%. But because I stayed in cash, I prevented myself from losing money. So this account is up 14% compared to the 1.6% in the S&P. It's almost got a 9, 10, 11% increase or multiple over what the S&P is. It was like, I've done like 10 to 12 times better than S&P. That's a better way of saying it. Okay. Look at the full portfolio, my full portfolio where I encompass every single strategy I've made. 38% for the long term, 37% for the short term account. Okay. Now, and I made my first trade in that account on 12/17/2012. So the S&P here on 12/17, back in 12/17/2012, closed at 1430. Now the close today again is 1588. I subtracted those and it's 157. And for those who aren't savvy on calculations, what you do is take the dollar loss or gain, which is 1573.83. You divide it by your starting balance. The same thing, same way you do your option calculations. And that's how you get the percentage. You're going to get a decimal at first. And so you have to take that decimal and multiply by 100. So you get that 11%. So remember, people always say the S&P, the market only averages 9-11% a year. So far, halfway into the year, they've earned 11%. Now this is better than this whole 1.6% here. So this is more realistic. So the S&P for the year, it's up about 11%. Okay. The S&P is up about 11%, but we're up 38, almost 40%. So I'm doing 3 times better than the S&P. Now, I don't want to make it seem like I'm beating my chest because really I'm not up 3 times. You know what's up? Option trading is. And this gives you and shows you the power of options trading and why you have one of the world's most powerful investing tools at your disposal. It's because, with traditional investing, these are the traditional results you get, the 1.6% or the 11% for the year. But with options, if we're patient enough and if we're disciplined and mature enough, we can use them to enhance our investing. And that's what they should be used for, is to enhance your investing. Not the whole cowboy trading, gunslinging trading where you're trying to turn $1 million into a year. Yes, that's possible, but it's also not very likely. So I'd rather you do a little bit of that cowboy slinging on the side. Yeah, take a small amount of money and have fun with it. But the bulk of your trading should be very responsible, disciplined approach to investing the market. Okay, so that's all I really have to say on that one. So thanks, Tim, for sending that. Now I have one other question for you, and I actually usually review the big 3 here, and I I might touch on it here in a little bit when I answer this question right here. So let me go to this Word document, and I think that'll be it that I'll have for you. So I have that pulled up because it's a long email. And I think it was like 6 or 7 questions in one email. And so just for an admin note, you all ask your questions, please. But keep in mind that, this is with all due respect, I'm not trying to be mean. This is kind of like thinking out loud via email, and you kind of just send what you're thinking. But the challenge with us is it's hard for us to answer this, because I was sitting here going through it to make sure I can answer everything. And it's like bare minimum 6 or 7 questions in here. That's tough. It's tough for me. It's tough for Bellama, and, just try to make it more short and concise. So that way we're trying to get to the root of what you're trying to ask, instead of trying to pinpoint all 6 or 7 questions all at once. Cause you multiply something like this times, we get 100, 200 emails a week. It's kind of difficult for us to really serve you and help you the best when we're trying to really get to what you're really asking. So I will read this and I will answer it kind of where I think this person wants to know. All right. So here it is. Question. You said to follow the story the stock is telling us correct. If I understand correctly, you said it's better to stay away from the news because they just think of any reason to explain why stocks are moving in the direction they are. I took that advice and ran with it. I watch a lot less news and I read my trend lines and quarterlies way more. Congratulations on taking that advice and running with it. Congratulations on watching the news less and paying attention to the story the stock is telling you. All right. So great job there. Now, the question of concern is if we follow the story to SPY, it's telling us to expect a small potential large dip in price value. It broke the downside trend lines and is mimicking some patterns of the past. So I pulled everything out and I'm just sitting in cash. I'm sitting in cash also, well, aside from the trade I made today. With pockets as deep as the Fed's, wouldn't they be able to change the story of the stock? Based on that story SPY is telling me, I'm seeing a negative 5% correction in the price coming up pretty soon. I could be way off. But if the government is trying to prevent this, is it possible for them to prevent the correction by pumping all this money into it, or does it even matter? Well, I guess it matters to an extent. Yeah, they could, pump the stock market up, but you know what? Their money has to run out eventually. Here's the truth. It's even in the Bible. The truth will always come to light. So they can try shenanigans all day long, but eventually the truth will come to the light. You know what? And eventually the stock market will crash, because reality dictates that the stock market always crashes. It goes through cycles. We can pull up the 10, 20-year chart. It goes through cycles. So yes, the Fed could do some shenanigans and hold up the market, but does it really matter? Their shenanigans have to run out eventually, and the truth will unfold. It's sort of like the last bear market. People were running up the price of real estate and easy money, easy credit, and after a while, that stuff had to end. You know what? And the truth came to the light, and it kind of bumped people out of their houses and out of the market what people say that didn't belong to be there. All right. And I'm not going to go so far as to say that. I just say they were just innocent victims and they didn't have the education that you have. All right. Now let's come back here. Also, how long do we sit in cash in a bear market? I'm not saying you sit in cash in a bear market. I don't sit in cash in a bear market. I trade a bear market for sure. My plan is to make at least $500,000 to $1 million in the next bear market, because the stock market went up from 2002 to 2007. So that's about 4 years. It crashed in 2 years. So you make your money faster in a bear market, and volatility's increase. You'll have 100 to 200, 300% returns in investment in a matter of days. Where in a bull market, it might take some weeks. So, I plan on aggressively trading in the bear market. I don't plan on sitting in cash unless it's for like my long-term, like stock investing or something like that. So anyway, do we wait for the 200-day moving average to move in the same direction as 8 and 23, or can we jump in, put options sooner? I'll wait to talk about all this if we ever get to a bear market. I'll actually walk everyone through it as it's happening, so you don't have to worry about that on a lot of calls. We review the market all the time anyway, so I won't even touch on that and speculate on that. Also, do we have a different set of moving averages for down markets? It would make sense, wouldn't it? I use the same moving averages. This is kind of cool that I have a mentor doing this. In my first down market experience, it's my first down market experience. It's one thing to do the analysis of down markets in the past, but a whole different story when you're standing in the middle of it. I'm glad you and your team are here. See you in the next live call. Hope you have enough questions to have a small one. Down markets are kind of exciting with your knowledge in my head. yes, down markets are exciting. That's why I said I'm excited. If I can't wait to a bear market, because my goal, like I said, is to make about $500,000 to $1 million during a down market, both on the way down and on the way up, because you make a ton of money on the way back up too. Pulling back up this 20-year chart here, it's usually a really sharp, quick upward movement after a bear market. So you can make your money just as quick there. So it's going to be my joy walking everybody through that. And that's why I said I won't feel like this coaching program is complete until I can walk everyone through a bear market. Once I do that, I think I might go back and retire again and get back to my little trading cave and my personal life and trade my own account, and so my family can travel and have some fun. We've been working really hard. We haven't really taken any vacations in a while. But anyway, the summary of that, it goes back to what I talked about in the beginning. Everyone's looking for reasons. I'm looking for results. You have to be careful. And I found it no surprise that I received that email on the same day that Ben Bernanke had testified, and it was all on CNBC. And it happens. Every time Bernanke's on TV, I get a bunch of emails from people asking someone along the same thing. What are my thoughts on the Fed's bond buying? And I don't have any thoughts. I honestly could care less what they do, because I'm paying attention to what the stock market is doing. I'm trying my best not to let that noise on the news affect me, and really get in tune here. The reason I'm in cash right now is because of the fact that I was in my trades and I started noticing that the stock market had closed below the 7-day, closed below the 8-day moving average, and it crossed below the 30. I was seeing all that stuff as it unfolded. Okay, you see all that stuff as it unfolds. You're going to see this shorter term moving averages point down. You're going to see them eventually cross through the longer term moving averages. You're going to eventually see the longer term moving averages point down. You're not going to be surprised. If you're paying half attention to what's going on, none of this should be a surprise to you. Now, the challenge you're going to have to do is either be objective and get out of your own head, because I can tell you the emotions, like Tim, me, everyone else, we might have had our thoughts as to what we thought. He thought the market was going to rocket up after the Fed meeting. There are other students who see the market pulling back here. They saw the market pulling back here, and they refuse to get out trades because they thought the market would go back up. Well, they lost a lot of money, all right, because the market doesn't care what you or I think, all right? It doesn't. So they couldn't get out of their head to see what was really going on, okay? Going back to that analogy of who I used to be, the bad boy. A lot of people can't get out of their head and then see who Travis really is today. Same thing with the stock market. So that's why I don't watch the news. If you can watch the news and it doesn't affect you, go for it. But it affects me. And so that's why I have CNBC on right now. It's muted, and it stays muted a lot. And sometimes if I have it on, it's just background noise. Just, I kind of laugh at it sometimes or keep my ear to the ground. But it's funny. It's just like if I notice it's starting to negatively affect my trading, it goes off. And so I kind of pay attention to that. But so far, I'm doing a good job of balancing that, keeping the news off, not getting caught up. If they get too negative, and I turn it off, I just get really sick in my stomach. I'm like, I'm tired of hearing all this negativity, this trash. And I turn it off. I'm like, I don't have time for that. And I really look at what the stock market is doing. All right. So those are my thoughts for you there. That's what I have. I have no idea where the S&P is headed right now. All I know is that the 30-day is starting to point down now. All the longer-term moving averages, the 8 and 23 on the DMA, all that stuff is starting to point down. So according to what the stock is telling us, yes, there should be some more downward movement coming soon, but it doesn't mean a bear market is coming. We're not quite there yet. Honestly, if you think about here in October 2012, we saw the same thing. We saw the shorter term moving averages going down, then eventually long term moving average went down. The market, let's pull up a 1-year chart. Let's see how long this downward move lasted from about September 2012 to November. So September, October, so 2 months. So it was a 2-month of downward movement, and it could be like that now. So it doesn't mean it's a bear market. This wasn't a bear market. People might have thought it was one, but the down move eventually ended. And when it did end, well, guess what? We paid attention and we saw when it ended. Let's take off all these studies here and go back to the basics, the simple little trend lines here. Actually, we can do a line chart here so you can see the trend lines better. And actually, let's draw this trend line. This stock market was going up. It broke the trend line. Wow, magically broke the trend line that had held for like 4 months, and then it went down. And when it was going down, it broke this upward trend line, and magically it broke this trend line and held for 2 months, and then the market went up. It's again, I'm being facetious and sarcastic, but it's really just this simple. If we can get out of our own heads and stop trading based on emotion. Same thing here. If we draw this trend line, this one is a tougher one to get all these points in here. And actually, let's draw it right here. We're going to miss this point here barely. But even this trend line, we can see the SP went up and it bounced down and always bounced down, touched the trend line. This is an area of support. It's an ascending level of support. The market tested ascending level of support and it finally broke through this ascending level of support here. Okay. Same thing, it broke through here, but this time it broke through. Let me extend this line. It broke through. It tested this level, which now resistance, and it failed and it crashed. So that's another reason why I think there's some more downward movement. Okay, and that's with no technical indicators. You don't need technical indicators. This is called naked chart trading. And there's actually one guy, I haven't seen his website in a while. I forgot where his website is, but he's a guy that teaches people how to trade naked. Yeah, I think he called it trading naked or something like that. That's how I remember him, because I was like, oh my gosh. And this is how he trades. He doesn't use any technical indicators or anything, and you don't need it. Honestly, you break this trend line, you could buy a long-term call option right here and just ride it until a situation like this. And I promise you'd have made a ton of money here. It's tough, riding through these up and move gyrations, because you're going to watch yourself lose and gain money so much. But if you're patient, you can do that. All right. So there's several different ways you can trade the market. I've just showed you the ways I trade. And I'll give you extra tools along the way to get your wheels turning, so you can eventually create a style that works best for your particular personality. So as usual, I hope this video has added value to your life. I hope you have a great week. And if you have any questions, you know where to find me. You take care. Talk to you soon. Bye.